Okay, hello again, everyone. It's Dima Khoury with Compass in Burlingame. So I'm back to bring you information and update on what's happening in San Francisco market between the single family homes and the condos. And also, I'm going to go through some statistics and facts about the forbearance market, the interest rates, and the comparison between today's market and the last recession, because we do have some buyers or sellers or homeowners are inquiring whether everything that's happening is going to lead into another real estate crisis. So let's look at the numbers. And to start with, interest rates, this is great news. Interest rates has gone down for the past week. So we're now at 2.61%, which means that there's more thousands of dollars to be saved by buyers if they get in contract and lock in interest rates, whether it's for their home or even for investment properties. This is such a great time to buy, which leads to a great demand on the market. Yet we're experiencing lower inventory right now. So it is still a good time to sell a property. Even in San Francisco, we are definitely experiencing lower inventory level, and the numbers are improving for the condos. Now, let's look in general about what's happening, or the comparison for the market between 2009 and 2008 and 2000 um, and today. So again, going back to this slide, so this obviously we can see the difference in interest rate. So we're now at 2.67%, which is lower. Definitely, some of the buyers are able to lock in 2.61. So check how much you can qualify for. And now comparing the 2008 with today's market and what led to that crisis versus what's happening now. So looking at the annual home price appreciation, that's the first metric that we would look at. Now, the 6 years prior to the crisis, home values were appreciating at 8.6%. The lowest was 6.5%, and the highest was 2.4, 2.5 at 12.5 and 11.4%. Now, the previous 6 years, we can see that in general in the US, the appreciation is very healthy. So it was at the lowest as was at 4.4%. The highest was 2017 at 6.4%, and last year it was at 4.7%, and it's very similar this year. Now, the inventory levels, so we can see that in today's market, we're a seller's market, and we're at a very low inventory level. And comparing this to 2008 crisis, so prior to that, 2006, 7, and 8, we had a high inventory, and it was a big time buyer's market, and the highest year was 2010. Now, another very interesting fact or piece of information with regards to the total home equity cashed out by refinancing in billions. So we can see that 2005, 6, and 7, the total was $824 billion that were cashed out by refinancing by the homeowners. Comparing this to today, so the previous 3 years, 2017 was 71 billion, 2018 87 billion, and 2019 89 billion. So we're at a total of 247 billion in comparison to 800 to 24 billion. So this is another um, great difference of what was happening prior to the crisis and today, what had happened before. Now, another great information, or another important piece of information, which is the equity levels. So 58.7% of the homeowners have 60% or above in terms of equity. So this means that the home values needs to drop 60% or more in order for these homeowners to be underwater. So this is, I don't know if this is going to happen. It doesn't look like, hopefully it doesn't. Now, 42.1% of the homeowners own their homes free and clear. So these are very good numbers to really answer the question whether we're heading into another real estate crisis or not. Now, looking at the history of the recessions, as we always say, recession doesn't mean a real estate crisis. And looking at the history in the recession during 1980, we had 6.1% values, property increase in terms of value, and 1981, 3.5% property values increased to 1991, 3% drop, and 2001, 6.6% increase in property values, and in 2008, as we remember, the average was 20%, almost 20% drop in property values. Now today we can see that we're at 7.3% appreciation for home values. So these are the differences. Now going back to the forbearance, and this is a newer number. Now, as we said before, the original forecast was at 30%. So there was definitely a pessimistic look at the housing market. So it was expected that there will be 30% of the homeowners to be in forbearance. Yet the actual peak was 8.6%, and currently we're at 5.5%. And looking at the current, what's happening with the families that are in forbearance, now, so the number was 6 point almost 5 million families. Now, 2.25 of them have asked for an extension for their forbearance. 2.54 have done or removed while performing, and 625,000 families have paid off their mortgages. So which like we can see that 48% of the families that were in forbearance are done now, and we have 500 or almost half a million families that are currently active, have active forbearance with the original terms. And again, 2.2 have extended, half a million are with the original term. And we have almost half a million or slightly more families are unfortunately their forbearance has expired or they're delinquent. Even if we only have one family, this is not good, but looking at the percentage, this is a low percentage in terms of the big picture, but hoping that these numbers will improve. Now, going back to San Francisco and the details on the activity for the previous week. So we have definitely experienced lower inventory, lower number of properties coming on the market. So the total number of properties that hit the market last week were 47 properties in comparison to 66 the previous week. So this is almost, I would say 25%. And 25 of them, of the 47, are condominiums that came on the market. And the properties that went in contract are 117, and 82 of them are condominiums. And the properties that closed escrow are 108, and 62 of them are condominiums. Now, the number of properties that came off market were 113, and 85 of them were condominiums. Now, looking at the absorption rate, or how many months or days do we need to sell the current inventory. So for the single family home, where it's still at the very stable number, so which is a month and 1 day to sell all the inventory on the market. So we have currently 245 properties. This is a great number, like 1 month to sell all these properties. And for the condominiums, the number is definitely improving. So it dropped from 2 months and 19 days to 2 months and 2 days. So we need only 2 months to sell 800 properties, the 800 properties that are currently on the market. So this is really a good number, and it definitely reflects a demand, slightly more demand on the from buyers, and lower inventory. And we definitely see that. I would like to share with you a very interesting slide that shows us the density in cities. So looking at the Bay Area population density, so we can see that the San Francisco area is the highest in terms of density level in comparison to all the other counties. And this is obviously because we have very small area with a lot of towers and for sure a lot of people. Now looking at the median housing sale prices, so we can see that the top is San Mateo County at 1,765,000. Number two is San Francisco at 1,665,000 in home values, or the median home value. Now looking at the housing market or the single family homes in San Francisco, we see is that last month we were still at the seller's market, and now we're more. So the numbers, as we said, are definitely improving towards bias to more towards more seller's market. And looking at the median sale price at 1.77 million, the price per square foot on average for the previous week, where this is for the previous week, was $970, and days on the market 77 days. Price decreases. Almost 30% of the properties that were on the market experienced price drop. Price increases 6%, and properties that were relisted 17%. Now, the most expensive home that sold was to 25,800,000, and the lowest expensive or the least expensive was $399,000. Now, looking at the condo market, we definitely see there is improvement for the previous week towards more bias towards a seller's market, and in comparison to the previous months. So as we just similar to the numbers that I just mentioned, it's obvious that the numbers are increasing this month. And in terms of median sale price for the condos, it was it is 1,200,000, and the price per square foot is $1,060 per square foot. Days on the market 90 days. So obviously it's taking condos longer to sell than even on the peninsula. Price drops, 31 properties experienced price drops, and price increases 1%, which means that the trend is slightly or going towards price drop for the condominiums. 9% of the properties were listed. Now looking at the most expensive, again, the most expensive was 25 million, and the least was probably, this is a rental, the system pulled a rental price. Now these are the San Francisco numbers, and how's the condo market doing, how's the single family market doing. So if you have any questions with regards to your property, how to go on the market, how to market it, what to do with the property, what kind of updates or upgrades you would need to sell in this very aggressive market, I'll be more than happy to share with you any information. And of course, you definitely would need more information with regards to districts, because the trend in districts is even different. So I can definitely provide you with details. So please feel free to reach out. And I'll leave you now. Please be safe. Happy holidays. And we'll see you next week.